o'clock. We want to welcome you to our webinar that's geared toward nonprofit organizations. My name is Robin Ryan. I am a senior manager in the Audit and Insurance Group at Grossman, Yannick & Ford. Many of you may have met me when you've attended some of our seminars downtown. So for those of you who are used to our seminars, we're glad to have you here. And for those of you who are new, we appreciate that you are here, and we hope that you find the information that we are going to transmit helpful. I'm joined today by Bob Grossman, who is a partner in our tax and valuation group, and Bob and his team have been hot on the trail of keeping up to date on all of the PPP and other aspects of the CARES legislation. Jason Hardy, who is a manager in our audit and assurance group, is also going to be participating. So we want to start by just saying that while the current situation is something that is unprecedented and really makes the expression "things can change on a dime" a reality, we realize that organizations, all organizations, are facing similar challenges, whether it's HR related, risk mitigation, communications with customers, clients, or providers, and financial implications. Our decision today to focus this on the nonprofit community is because we recognize that often that community or you guys do not have the resources of larger organizations. Obviously, capital, the access to financial resources, cash, is often an issue, as well as staffing. A lot of nonprofits from an accounting perspective run very, very lean. And so for some of you, it's a little harder to get this information than maybe a larger organization. The other interesting fact with nonprofits is, since many of you have a June 30th year end, you're going to be in the middle of this pandemic and this situation and trying to close your books, address whatever disclosures are required because of this and the impact on your business a little earlier than the average person who's going to be for-profit, who's going to be ending their year possibly in December. We've chosen to call this Welcome to the Next Normal because, again, the situation is going to continue to remain fluid, both the status of the virus and really the impact on your organization and how you're going to be able to serve your constituencies and carry out your programs. The other thing is the new normal. It's a term that's been used repeatedly. I can tell you, I, for one, am sort of tired of that term because, again, it's too soon to talk about the next normal. So when I heard the expression, or the new normal, I heard the expression next normal, I thought that was more applicable. We're going to start today by talking quickly about our objectives, which are right here. We're going to, again, talk about the newest information related to the PPP loans and the forgiveness. The application for the forgiveness came out on May 15th. It is available on the internet, and if you would prefer, one of us can email it to you if you want to take a quick copy. Also, there was additional guidance issued by the SBA last week. Bob Grossman is going to talk about all of that. He's going to do a high-level discussion today simply because we have other topics we need to talk about. So if you were interested in a more in-depth discussion, Bob and his team will be doing one on Friday, and you are certainly welcome to sign up for that webinar. We are also going to address the accounting for the PPP loans, the proceeds, and the expenses, simply because that's an issue that people have actually asked us about. We're also going to address some items of financial concern to your organization. Again, Jason will be covering this, and this is where I'm sure some of you have started these processes, but it's just a reminder of things you need to consider and or can begin honing in on as you look at this for the long haul. We're going to talk about the impact of COVID-19 and what that means towards your audits. Again, that is going to be directed more toward those of you who have possibly a June 30th year end. And last, assuming we have some time, we want to talk about some technology considerations. So we're going to let Bob get started with his part of the program. Bob Grossman, thank you.
Thanks, Robin. Hello, everyone. Welcome again to our webinar this afternoon. We hope that the materials shared today and the information bring a little bit of value for the time that you've surrendered from your busy schedules. As Robin said, we're going to talk about PPP loans, and we'll talk about exactly what that stands for in a moment, and some other tax-related matters. Not so much tax as, do you want to advance up one, Robin? Yeah, we're going to look at the Paycheck Protection Program loans, the PPP loans, and we'll probably spend most of the time that I have to share today on that subject, at least at a top level. But there are other economic incentives or initiatives in the Coronavirus Aid, Relief, and Economic Security Act that was enacted on March 27th, the CARES Act, and those include traditional economic industry disaster loan programs. That has always been part of the SBA's bailiwick, if you will, for helping small businesses and smaller organizations that have gotten into financial trouble as a result of any number of items, can be economic to tragedy and disasters. The law also included an enhanced charitable contribution deduction allowance for non-itemizers, itemizers, and corporations for this year alone, 2020. But while it would be nice to have that extended, and it may, of course, be extended at some point in the future legislatively, now is when the funds are needed. So it provides some help as well that you should be familiar with as executive directors and managers of not-for-profit organizations that are allowed to take those contributions. In addition to the Paycheck Protection Program and the Economic Industry Disaster Loan Program, there's also a couple of other options that have not gotten as much play as they might have deserved, primarily due to the popularity of the PPP loans and the ongoing information sharing that's gone back and forth between SBA, Treasury, and employer borrowers under that program. These include the employee retention credit, which is a credit for maintaining your staff, your people through this difficult period. And then lastly, a deferment of certain payroll taxes for employers, which Jason will speak to a little later as a source of additional cash flow. And we'll get into each of these, at least on a cursory level. And as Robin said, you're invited to send questions through the chat room. And if we can't get through them today, we will get every question answered through the email back to you as soon as possible. So with that, we'll get started and talk a little bit about the PPP program. And that program, from a background standpoint, the important thing to remember that the emphasis was on maintaining payroll, which means maintaining jobs. And that's really what Congress's intent was, as well as the administration, in moving that through. You'll see as we talk about it a little more that a lot of the interpretive rules that weren't part of the laws that were passed, basically promulgated by the Small Business Administration and the Treasury Department, adding interpretation, almost like Treasury regulations for the Internal Revenue Code, that the emphasis on these rules is the protection of jobs. And so we've had a lot of questions over the last, 65 days approximately since the tax bill was passed on what does all of these items mean. But rest assured that the authorities that are governing this program are emphasizing, maintenance of the jobs, keeping those jobs in place through this difficult period. And that was the point of the legislation, was to keep people off of unemployment and keep them working. And so that's the point of this program, period. This was a major program with $349 billion allocated in the original legislation. That got swooped up very quickly in round one, and they came back and approved another $310 billion in round two. Right now, I don't know about right now, right today, but I would say as of last Friday's SBA report, they report weekly on the status of the PPP program, and $549 billion had been doled out or allocated under the program through that day, through last Saturday. So there is monies left. There are monies left if you've not yet applied for a PPP loan to have an opportunity to go after that loan. Really what you're looking at here is a loan program for small business that essentially is an extension of traditional programs that the SBA have handled in the past. Under this PPP loan program, the key element is that all payments of principal, interest, and fees, those are all deferred for at least 6 months. In some cases, the fees are reduced by the lender institutions. the most major element of this, which is of most interest to not only not-for-profit organizations within our local economy that we've talked to, but also for-profit businesses, is this eligibility for forgiveness of the loan. In effect, I mean, if you think about it, you have an ability to borrow $1 million if your payroll supports a loan at that level. You get the $1 million and then you never have to pay it back. I mean, that's an unusual circumstance. These are, of course, unusual times. And Congress, you know, we all have a aversion to some of the nasty politics that we see in Washington, but what happened through this coronavirus campaign with respect to the economy and the fast reaction by Congress and the fact that the parties were able to get together to resolve this in a fairly substantial manner is something for which they should be commended. There's just no question that this was a very magnanimous effort on their part, and it worked to at least alleviate a lot of the stresses that we might have seen otherwise in the economy itself. So they are eligible for forgiveness, as I've said, so long as you spend the money in a certain way. And as you see, we'll get into this, the lion's share of the money that is borrowed, the original proceeds, have to be spent on payroll costs. And we'll talk about exactly what that is, but you can also have some other operational costs, and the ones that are listed in the statute under the CARES Act include mortgage interest on real or personal property, rent payments on real or personal property, and then certain utility costs that are incurred between February 15th and June 30th, 2020. So that's the first thing to take away from this, is understand that this is a time-sensitive provision and that what it was intended to do was get us through this quarter. That's not to suggest that there won't be more stimulus packages in the future, or that there'll be other changes in the tax law to compensate some of this. But the reality is, even though it ends on June 30th, right, you know, the original statute was to basically see that these proceeds were to keep businesses alive and keep their payroll paid through that date. Not so important for our guests today that work in the not-for-profit community, unless you have income subject to unrelated business income tax. But the loan amount forgiven is excludable from gross income. So historically, loan forgiveness is governed under the Internal Revenue Code, under Code Section 61, and it really is a taxable event. And that makes perfect sense if you think about it in the traditional sense. Someone loans you $500,000, you're unable to pay for it as a tax-paying entity, as a for-profit, they forgive the loan. Well, then you had an infusion of capital and economic gain that you didn't pay tax on. So historically, that's always been a taxable event. In this particular case, it's an important thing to understand is that they are excluding that from taxable income. And so you will have, for-profit entities and for people attending today from the not-for-profit community that have unrelated business income tax on part of the operations of their organization, will have a chance to get this debt forgiveness without paying income tax on it. Now, the flip side of that was a question that was left unanswered in the original CARES Act, and I'm not sure if I have another slide on it, but it's a good time to talk about it, is that the deductions that are associated with the payment of expenses under this particular loan proceeds in this program will not be deductible. So that's raised quite a stir with Congress. And so ultimately, there's been legislation introduced through the Senate that is sitting at the Senate Finance Committee level right now, which is meant to reverse the IRS's ruling that came out a few weeks ago and basically say you can deduct this. So if you get a $500,000 loan and you pay 100% of it as payroll, for a for-profit entity, historically, they would have to pick up the income on the debt forgiveness, by example, $500,000, but they would get a corresponding deduction for all of the expenses that they paid with that money, $500,000, and it would be a wash. What happened in the program that we have here is they get the same $500,000. Congress says it is not going to be taxable when it's forgiven, but the IRS has come out and ruled that, you know, if it's not taxable, then then the amounts paid that are deductible expenses generally with those proceeds will not be deductible in this case. So in both of those examples, you see the net effect on taxable income is zero. So again, from the not-for-profit perspective, I think it's a very positive thing that you can get the loans forgiven. It doesn't really matter about the deductibility of operational expenses paid with the loan proceeds because you guys aren't subject to income tax to begin with. This program is, as I said, part of the traditional SBA programs. This is their 7A loan program, but it has some distinguishing characteristics. First, that the PPP loans are guaranteed 100% by the SBA to the lenders. So there's no risk at all to the lenders that are involved in these loans. The program was legislated, through the CARES Act, of course, to be directed by the SBA in consultation and in conjunction with Treasury advice. So the SBA rules, as they have released them since March 27th, have played a significant role in the mechanics of applying and obtaining the loan, but also, and perhaps even more importantly as well, with the loan forgiveness requirements that have continued to trickle out of the SBA right up through last Friday, as Robin indicated earlier. So those are the things that we're going to talk about as we get into this in a little more detail. Robin, how about flipping to the next one? Thank you. The first point in understanding these loans is to know who's eligible for them. And certainly many of you on the call today have already gotten loans, so you understand that your particular organization qualified as an eligible employer borrower in this NFP sector. Primarily, it's 501c3 organizations that are exempt under 501a, but it also includes 501c19 veterans organizations and tribal business concerns. So it was fairly limited in the not-for-profit sector and excluded trade associations, advocacy organizations, unions, social clubs, etc. So it's a fairly limited group. Although I would say that most of the organizations that we work with at Grossman Ford are exempt under 501c3 and 501a. The amount that can be borrowed under the loans, we're capped at $10 million for each eligible employer. And so that's another requirement that's there. And finally, the other major requirement that we found in helping people process these loan applications up front was that you can't have more than 500 employees. The SBA has two different tests. The 500 employees is what we would refer to in the tax jargon as a bright line test, meaning that if you have less than 500 employees, you don't have to worry. There are, though, other SBA existing size standards, and on the SBA website, you can simply go in there, type your industry code in there of what your organization is, your North American Industrial Classification Code, and it will tell you what size means against your organization. For example, again, outside the not-for-profit community, but we've saw companies in certain industries where 700 employees were deemed to be small enough to qualify for the loan, even though they exceeded this 500 safe harbor. From the not-for-profit community standpoint, keep in mind that when counting these employees, volunteers, unpaid individuals that contribute to the success of your organization are not counted in conjunction with determining the employees, either at the application process point or at the forgiveness point on the other end. So today we're going to spend, what time we have on this particular issue talking about the loan forgiveness, because that really is probably the most important element of these PPP loans as we move forward and try to get a grip on how best to help our organizations. Obviously, if you don't have to pay it back, that's far better than if you do, no matter how glamorous the terms are of the loan that's remaining after the fact. So as I've mentioned several times already, and you'll see as we go into the complexities of the calculations a little bit, what you're really dealing with is spending the money in a way that protects the jobs and positions of the organization that were in place prior to the coronavirus pandemic. And that's where we're going to go from here. Next. So it's a multiple step process, and it's evolved over the 60 days, 65 days since the passage of the law. And though it requires a lot of statutory consideration, with respect to the law as passed, anytime that Congress, works to pass a law this quickly that throws $2.2 trillion out into the economy, there's going to be shortfalls in information and things that were overlooked. And this is no exception. So what we've seen again is a number of interim final rules. It's interesting, that word that they call, it's the final rules, but each time they came out, they're interim with a later date. And basically it was for the most part, these rules are issued as frequently asked questions on any number of related topics to the PPP loans, both from the application standpoint, the certification process, the employee determinations, to the forgiveness process. And they continue to do it that way. And so we've continued to do that, build our understanding of this laws from that type of guidance, if you will, that's out there. So the first aspect of it is the PPP loan, won't be forgiven unless you meet the following conditions, in its entirety. So first of all, and it's not mentioned on this slide, but we'll talk about it in the next slide. The first thing is, if you borrowed $500,000, you have to spend $500,000 in the 56-day period. Or we'll talk about it very briefly. There's been a new alternative payroll period for covered payroll that was introduced last Friday. But you have 56 days in either case to spend 100% of the proceeds in the way that the SBA says it should be spent. So that's the race, if you will. You just have to determine what the start date is of that 56 days. So when you look at that and you suggest that 100% has to be spent, then you have to look at how does it have to be spent. Well, no more than 25% of the forgiveness amount can be used for non-payroll expenses. So 75% is the amount that has to be spent then on covered payroll expenses. And that's an important discussion. Now, a lot of people have had difficulty dealing with that, and that's going to cause a lot of employers/borrowers the ability to get the entire loan forgiven in its entirety. That doesn't mean they still won't have a substantial portion of the loan forgiven, but you have to spend it in that 75-25 manner for the time being. I will tell you, and we'll talk about this when we get to the end of the presentation, that there has been new legislation introduced in the House just last week, House Report 6886, in which case a bipartisan bill has been introduced, which is going to lessen the restriction of the 25%. So I haven't seen the legislation yet. I know it's out there, and I know this point has been there, but I don't know exactly how they're going to do it. But it seems that this is going to be more flexible for borrowers in the future. So if you don't spend any more than 25% for non-payroll, you maintain the employee headcount, and the compensation levels for employees making less than $100,000 per year are maintained. And as an overall macro, you spend 100% of the proceeds, then you'll probably have the loan forgiven in its total amount. And that's an important, again, economic benefit from a cash flow standpoint. To the extent that the factors are not satisfied fully, or a business does not use the full amount of the loan in the 8-week period, then some portion of that loan will not be forgiven. And so ultimately that will be converted to a loan to the SBA. The terms currently now are 2 years at 1%. So it's a fast pay loan, although the interest rate's very attractive. Ultimately, that is another item, the 2-year term that's being negotiated in this, or not negotiated, excuse me, but being included in that new House bill that was just introduced this past week. So let's talk a little bit about the loan forgiveness calculation itself, and hopefully we can answer a lot of your questions in conjunction with this discussion. So there are 2 sections of the code or the bill that are relevant here. There's a section 1102 and a section 1106. And I don't want to get too tied up and tongue-tied in tax bill or stimulus bill provisions, but 1102 specifically guides the process of getting the loan. 1106 of the bill guides the process of getting the loan forgiven. So that explains to you when you're looking at those what you're doing here. So they're talking about an eligible recipient of a PPP loan. That's anybody out in the listening audience today that has gotten a loan or is looking to get a loan, shall be eligible for forgiveness of the indebtedness on a covered loan in an amount equal to the sum of the following costs incurred and payments made during the covered period. So the words highlighted in red on the slide are simply highlighted to indicate to you key terminology that needs to be understood in conjunction with getting the maximum amount of loan forgiveness that you might qualify for. So the costs that are in there include payroll costs, interest on covered mortgage obligations that do not include prepayments or any principal payments, any payment on any covered rent obligation, and any covered utility payment. So that's the broad provision that allows for the forgiveness. Now the key is to get in and understand the terminology. So the covered loan itself is the PPP loan that was first allowed under Section 1102 of the CARES Act. So covered loan is simply the PPP loan itself. That's what we're talking about, of course. The covered mortgage obligation is any indebtedness or debt instrument incurred in the ordinary course of a business that is either a liability of the borrower, not either, that is a liability of the borrower, is a mortgage on real or personal property, meaning equipment in addition to real property, and was incurred before February 15th, 2020. So it's not an either, as I said, it's all. So you have to meet all three of those. The covered period. Well, originally the covered period was the 8 weeks period beginning on the date of the origination of the loan. There was a lot of pushback from the borrowing community, the employer borrower community, as well as professional organizations like the American Institute of CPAs, that was too inflexible. And you'll see as we go through the materials, they've changed that very slightly, but importantly, to allow for the 8 week period to begin on the date of the first payroll after the loan borrowing date. And we'll talk about that. A covered rent obligation was rent obligated under a leasing agreement enforced before February 15th. Now, interestingly, the rent obligation itself did not talk about rent on equipment. That's something that was clarified later, though, and it is rent on both equipment and real property. And then a covered utility payment, which has not been through all of the frequently asked questions that have been issued and the further guidance that have been issued by the SBA, and Treasury, has not really been expanded beyond this terminology that was in the original statute. When we talk about covered utilities, we're talking about a service for the distribution of electricity, the gas bills, the water bills, the transportation, telephone, or internet access. So it's very specific on here, and it's not been expanded anywhere else to let us know if there's more or less that can be considered in conjunction with those. Thus, I think in applying for forgiveness, you have to keep a pretty strict line in conjunction with that terminology. An eligible recipient is the person that received the loan, the company or organization that received the loan. And then the expected forgiveness amount, which is the amount that the lender expects to forgive, includes basically the same things. So we're not going to go through this again in total. Now, the question is, in understanding, what is a covered payroll cost, those are payroll costs paid during that quote unquote covered period, or, covered non-payroll costs, you have to look into the definitions. So basically, payroll costs are defined as salaries, wages, commissions, or tips, capped at $100,000 per year per employee. So if you had an employee that was making $125,000 salary, perhaps an executive director, he or she would be capped in this calculation of the maximum amount borrowed that could be borrowed under this program to $100,000. There was some lack of clarification early on whether that was, in that example I just gave, 125,000 cash salary, and then that individual makes $35,000 or $40,000 in benefits. Was the $100,000 cap for all of that, or just the cash compensation? It was clarified later that's $100,000 of cash compensation. So in addition to that, you get to include the employee benefits, which we'll go over in a moment. I would also tell you that in the release that came out last Friday, the salaries, wages, commissions were modified slightly to include bonuses and hazard pay. So there is a capability, if you will, to pay some bonuses out to people that stuck it out through this difficult time to service the organization and its clientele or its exempt purpose. And those payments will factor into the forgiveness on the other side as well at the end. There was a lot of questions about hazard pay. There was no clarification on that. It finally came out last Friday. And it only makes sense, again, that paying people a hazard pay for working through this virus when many other people were safe at home, deserves a little bit of compensation. The benefits that we're talking about are vacation pay, parental, family, medical, or sick leave, allowances for separation or dismissal, payments required to provide group term health benefits, including insurance premiums, and finally, payment of any retirement benefit. For most of our clients, it's been an issue of vacation pay, healthcare, and retirement. Also, if you have, as an organization, employees located in some alternative jurisdiction that assesses a tax on compensation at the state or local level, those items are included as well. Note importantly that the FICA taxes that you pay on that employer as an organization, if you're in the Social Security system, will not be deductible or will not be considered. So I thought that's strange, but ultimately, I think that's because it's incorporated into other stimulus-motivated provisions of the CARES Act that we'll get to in a minute. So again, keep in mind that in determining both the amount of the original loan as well as the amount that's potentially forgivable on this side of the loan, the employer's share of the 6.2% FICA taxes will not be considered. For sole proprietors and independent contractors, this proved to be a lifesaver as well. And for them, it's very similar: wages, commissions, income. Primarily, though, for a lot of small companies and small sole proprietors, it's net earnings from self-employment, capped at $100,000. So for most not-for-profits, it's going to be a salary issue or a wage issue, capped at $100,000 per employees, plus those benefits. Let's move on, Robin, please. So again, what payroll costs do not include, they do not include any payments that are made to independent contractors. So if you have an organization that's used the services of an independent contractor, he or she is going to have the capability of applying for a PPP loan on their own. You're not going to include that in your loan application amount, nor consider that in conjunction with your forgiveness request either. And then the payroll taxes I just mentioned. Payroll costs do include payments made to general active partners. I think it would be unlikely that you would see many not-for-profits tied into a partnership transaction where that became a major consideration. Let's talk a little bit about the starting point of the 8 weeks. Now, the 8 weeks can run past the June 30 deadline. I mean, that's a question that, people are still getting the loans. Well, there isn't 8 weeks left or remaining before June 30th, which is the quote unquote official expiration date of the program. But the effects of the program are going to linger through until it all works itself through the system. I think that June 30 date should just be considered as probably the last date which you will have an availability of loan proceeds to borrow if monies are left. So the 8 weeks begins at a certain point, and that marks the beginning of the quote unquote covered period. And the covered period is important because that again is those dates that you have to spend the money on either end so that you can get the forgiveness and qualify for that when the time arrives. So not historically, but what the statute defined this date is the date of the origination of the loan. that was really meant to provide a starting point. And basically they did it with the idea that the first day that the monies were deposited into your account as an employer or borrower, that was the first day of the 56-day period. The FAQs, tried to clarify that later, saying that was the date that the lender makes the first disbursement of the PPP loan. So that frequently asked question, number 20, was one that ultimately answered the question definitively. So the clock started the day you had the money to spend. There's recent guidance, which is basically the May 22nd, 2020 release last Friday, looking at an alternative payroll covered period. And this was really promoted by the American Institute of CPAs, as well as a lot of people in the professional communities, both law and accounting and borrowers themselves, that said that you needed something more expedient. So they created this alternative payroll covered period. Keep in mind that the covered period still is 56 days. And so it's not necessarily measured as it was before. It can be done in an alternative fashion, but it's still just 8 weeks exactly. So under this rule, borrowers that have a biweekly or more frequent payroll cycle, and you have to qualify by being in a payroll cycle like that, that can begin your 8-week period, beginning with the first day of the first payroll cycle in the covered period and continuing for 8 weeks thereafter. So there are examples in the rules. We have them on our website, as Robin pointed out, that basically indicate that, if you borrowed the money on the 20th of the month, but the payroll cycle began on the 24th or 25th, you can wait for the 25th. You count that payroll and the amounts expended for covered payroll expenses, but ultimately the 8 weeks starts running from that particular day. Once you've done that, then you determine the total amount of loan proceeds that were utilized in the covered period for both incurred and payroll costs and other allowable costly covered expenses. Note that there was some question early on about incurred and paid payroll costs, and that's been clarified as well. It's not necessary, if you will, that the expenses are incurred and paid, quote unquote, the word "and" being quote. So that they can be incurred and paid, or they can be incurred or paid. And I know it sounds a little obnoxious and it's semantics, but that's an important distinction in tax law and complying with regulatory requirements. So if costs are incurred, but they're not yet paid, then you still are going to be able to use those in the determination of how much of your loan is going to be forgivable. That's an important element to understand, almost like an accrual. It wouldn't be logical, I think, and they've cleaned up the rules with this latest guidance last Friday, to say that you have 10 days of your pay period are prior to the end of your 8-week period, but then 3 days later you're going to pay the 3 days plus the accumulated 10 days. It wouldn't make sense not to give you credit for the incurred or earned payroll during that period of time, and they have corrected that now. If the covered expenses, which include both covered payroll and covered non-payroll, do not rise to the level of the loan proceeds that were originally borrowed, then that difference will not qualify for forgiveness at all. The 75-25 rule, it's an interesting thing. Again, this act was put together, this CARES Act was put together with the idea that this particular loan program would be run by the Small Business Administration instead of Treasury, even though they did have Treasury's assistance in making a lot of decisions. So what they decided to do, and this is not part of the law, I mean, really what you had was the SBA interpreting what the law was and suggesting that to accomplish the intent of Congress in the first place, 75% of the money had to be spent on saving jobs. This is not part of the statute or the law. This is also something that's being challenged in the new House bill that was introduced last week to get this 75-25 requirement lessened and make it less restrictive. So under the rule as it sits now, Not more than 25% of the loan forgiveness amount may be attributable to non-payroll amounts expended from the loan proceeds. So pretty self-explanatory. Most of the money has to be spent on the loan proceeds. Yeah, and meant to effectuate the purpose of the report as well. I did have I noted a question. Somebody asked, can you prepay your July rent? You can't prepay mortgage interest, and to my understanding, you can't prepay your rent either if you have multiple months. In 8 weeks, you would expect to have 8 weeks of rent. And if you prepay to get 12 weeks of rent, that's probably not going to work. Once you decide, you've met the 75-25, then you have to look and see if the forgiveness was in the proper proportions to qualify for loan forgiveness. Was the amount incurred or paid from the remaining $850 used 75% for the payroll? So what we're really talking about there is, let's say, by way of example, we borrowed $1 million. We only spent $850,000 during the 8-week covered period that we've just discussed. Well, in that instance, you have $150,000 that will not be forgiven under any circumstance. And so that will become a loan repayable under current law under a 2-year term at 1% interest rate. The other $850 then, to qualify for loan forgiveness, has to be allocated in the way it was spent to covered payroll and covered non-payroll. So if you used, of the $850, if you use 75% of the $850 for covered payroll, then the entire amount is eligible for loan forgiveness, and we move on to a head count and wage limitation calculation. If you have other non-payroll expenses, though, that exceed 25% in the remaining qualified loan, in other words, of the $850 in the example, if we spent more than 25%, perhaps 30%, on non-payroll covered expenses, then you're going to have 5% adjustment to the amount that's ultimately forgivable. And that's the limitations imposed by the 75-25 requirement. Now, it's an interesting thing because I do expect fast movement through the House, since that's a bipartisan bill introduced by both Republicans and Democrats, and the president supports it. So this 75-25%, this is valid today. I don't think I'm telling anybody anything wrong. What's difficult is, will this be the law in 3 weeks, 2 or 3 weeks by the time you apply for loan forgiveness? So you're going to have to keep an eye on these rules as well to make sure that you're getting the optimum outcome for your organization. The second step and the third step, we're talking about full-time equivalent employees. And that's a big step. And so what you have to understand first in applying this is that you as an organization, by receiving these funds, have been basically assigned the responsibility of keeping people on the job through this economic anomaly that the economy's experienced. And so you have to measure that in some means. And so basically they do it by head counts of FTEs, or full-time equivalent employees. So a full-time equivalent employee is an employee who works 40 hours or more on average each week. And then those that are working less than 40 hours per week are included in the reduction calculation on a proportionate basis. Now, interestingly, anybody that works under 40 at a certain hour level, you can use a factor which gives you credit for one half of a full-time equivalent employee under the rules that came out last Friday. We're not going to get into that in detail today, but we will do that on Friday if people are interested in that, to take a look at how that calculation actually works. But the idea is that, yes.
I'm sorry to interrupt you, but somebody had asked a question, and that this instance, this is at a private school, but I think it's probably true in many nonprofits. If an employee does not normally work 40 hours, for example, a teacher may not work a 40-hour week, possibly they work 35 or 33. And that's what that organization essentially considers them full-time. How does that work in this calculation?
That's a great question, and I don't know the answer to that, Robin. I could take a look, but I don't think there's any guidance on organizations or companies, for that matter, for-profit companies, where full-time employment is something less than a 40-hour count. They did it very mechanically in drafting the rules. I would suggest that's, if you look through the mechanics of the calculation that's coming through now, as a result of the May 22nd guidance, they use a factor of 1 for a 40-hour full-time employee. I think, in the instance that you're talking about on the individual's question, I would assign a factor of 1 to whatever their full-time equivalent is, whether that's 32 hours or 36 hours. If that's a full-time equivalent, I think they should get that full-time factor. And that would be comparable, of course, to the period that was used in the measurement of pre-pandemic anomaly in the economy. So I think as long as it's consistent, it should carry the day. That may require a judgment call, if you will, by the organization applying for the forgiveness, Robin. That's a great question.
Thank you, Bob.
I could look at that a little further, but I've read through everything multiple times. I'm certain that I've not seen any discussion of that particular point. Okay, we can move on to the next one. There's also a requirement to reduce the amount of any loan forgiveness by the amount of any reduction in total salary or wages of any employee that exceeded 25% of their pre-salary or salary prior to the pandemic economic effects. So you have these periods, these measurement periods, which are well defined in the instructions to the applications. And you look at this on an employee by employee basis instead of looking at it on the aggregate. So you almost have to set up a spreadsheet, not almost, you have to set up a spreadsheet which lists every single employee, put down what their salary was, for an 8-week period prior to the COVID-19 issues. And during this 8-week period, if the decrease is more than 25% in their overall salary as determined under these rules, then that decrease will serve to reduce the amount of the loan that's forgivable. One of the questions that continue to bother practitioners and commentators for quite a while had to deal with the idea that, well, if you have employees who have been let go for economic reasons, and so your full-time equivalent headcount is going to drop and you're going to have a negative effect on your forgiveness request, aren't they double dipping, because that's automatically going to result in a significant drop in total salaries and wages. That, it took a while to get them on that, but in the guidance that came out last Friday, May 22nd, they did in fact put a provision in which eliminates the double penalty to the loan forgiveness request. And so there is a means now by which, if the salary drops by virtue of the full-time equivalent employee drop, that won't be double counted in determining the amount of the loan forgiveness that you can qualify for. Okay. Yeah, the last thing I would say is and that's the next, we'll jump to the next slide, Robin, is that no, I must have missed one. It was back. Okay, this wage restoration provision, this is the point that is important. If you have an ability to replace your employees by June 30th, then your full-time equivalent headcount will be restored and you won't have any decrease to the amount that's available for forgiveness when you request it. Same thing with the wages. If the wages are restored by June 30th, then you'll have that same opportunity to not decrease the amount requested for loan forgiveness at that date. If the final guidance, again, keep in mind, does provide for an inability for the ability to eliminate being penalized twice for the full-time equivalent drop and the corresponding full-time wages drop. So keep that in mind as you apply as well. Okay. Next. Yeah, we talked about the federal taxable income element. Again, that's only going to apply to the participants on today's call, if you're subject to the unrelated business income tax and some portion of the original PPP loan was borrowed in conjunction with that particular unrelated business activity. Other than that, that doesn't provide a real economic benefit. But on the other side, you don't need the deductions we talked about earlier. Let's talk just for a minute about the loan forgiveness and the process. The process was laid out pretty well in the guidance that came last week and the Friday before. I think that was May 15th. And on May 15th, they did release about an 11-page document, which included a very brief short form, 3 or 4 pages of documentation that's required that they call the loan forgiveness application. And then there's some supporting schedules that are blocked in behind that form to help you calculate the numbers that go onto that form. It's pretty straightforward. I know that most of the participants on the call are not, in the mode of preparing, sophisticated tax returns or complex issues, complex compliance filings on a daily basis. But it is a rather straightforward form. I would suggest that everybody that's going to be applying read through the entire set of instructions and the forms so they have a comfort level with the mechanics of how it operates. But it's going to flow pretty much as we've described in today's presentation. Once that is filed with the bank, and it can't be filed, of course, until at least 1 day after your 8-week period is completed at the earliest. If your 8-week period lapses prior to June 30th, my understanding is that banks will start accepting this in early July, some as early as July 1st. Once the bank receives the application, they have 60 days in which they can approve the loan for forgiveness. Once they do that, they will inform the SBA. The SBA will pay the loan off to the bank on behalf of you as the borrower. There are financial reporting matters related to these loans, and they are a little bit different, so I'll defer to Robin to address those issues.
Thank you, Bob. And I know we had some other things we wanted you to talk about today, but I think in the interest of time, because I want you to be able to talk about those and give them their due, we're going to recommend that some of the other issues related to the CARES Act, whether it's the EIDL or the deferral of the payroll taxes or the employee retention credit, since Bob and his team are doing a webinar on Friday, it might be better if they just sort of tune into that. Some of this will be a repeat, I'm sure, of what they've heard today, but then there'll be more documentation and more information provided then. Is that fair, Bob?
Yeah, that's absolutely fair. That'll be a far more detailed look at some of the articulated changes that have come through in the last couple of elements of guidance.
And then for those of you who have listed some questions, I think Bob has addressed some of those. Some of them he may not have. So what we are going to do, again, in the interest of time, since Jason and I had some other things to cover, we will go through those and we'll either respond to you directly or we will make sure that Bob gets those questions so that if nothing else, they will be addressed on Friday, because they were all, I think, very good questions. You brought up some good points. And it's always easier to do a presentation whenever we have an idea of what people are interested or what questions they have about our information. So on that note, I'm going to start talking about the financial reporting matters related to the PPP. Fortunately, I talk fast. So, and I guess if I hit my own slide, that would be helpful, would it not? We're going to go right here. So tracking it within your accounting system, and this is something I've had a number of calls about. So when the money gets into your system, the first thing you need to do, of course, is you need to add it into your accounting system. Whether you do that, whether it went into your normal bank account, whether you opened a different bank account, you want to be sure that you record the debit as the cash. Your credit is going to be tracked as a liability, because until it is forgiven, it is in fact a liability. And this becomes especially important for those of you with 630 year ends, because it will be a loan at that point. It will not convert to income until you've actually received the documentation from the bank that tells you how much of it, and hopefully all of it, will be forgiven. When you do enter it into your system, it would be a short-term liability simply because at the point the loan originated, the expectation is it will turn around quickly. Once you receive your information from the bank, then you can then turn around and record it as a long-term loan as necessary. I think Bob's already discussed this quickly. We want to remind you to carefully track the expenses. He's talked about what expenses are covered, payroll, and the other eligible expenses. Of course, do your adjustment for salaries over $100,000. I would also suggest that, and Bob noted a spreadsheet, you want to track this as it's going along. When you see the application, and again, there are a lot of pages of explanation. The application is not that long itself, but you don't want to be filling out a form that you are uncomfortable with or you are not used to filling out and trying to accumulate information all at one time. Sometimes it just doesn't work really well. So you're better off to start tracking the information as it's going on now, and then it'll be pulled together. You can do a review before you do the final application. And also, while the SBA has indicated that they are not going to audit loans below the $2 million, remember you are talking to a few auditors here. I would suggest that any documentation that you have to support the expenses that are going to be used for this loan forgiveness, I would suggest you keep copies of that. And then at the point when the bank tells you that it has been forgiven or what parts of it have been forgiven, the forgiven portion then goes from your balance sheet onto your income statement as grant revenue. And if there is a portion that needs to be repaid, then of course that again remains as a liability. And then based upon the repayment terms, which I believe are up to 2 years, you can then classify that as a long-term liability. The next thing we're going to do is let Jason talk about managing finances in ongoing uncertainty. And I have to apologize. I think I came up with that title, and I'm not sure why I did that because it's hard to say. But anyway, Jason, why don't you go ahead and get started on the considerations that you need to be taking into account during this period.
Thank you, Robin. All right, there we go. Can you go back one slide? Oh, thank you. So one issue that a lot of nonprofits are dealing with right now is with respect to how to manage their cash in this time of uncertainty where you need to keep your doors open, you need to keep operations going, you need to be paying your people, but at the same time, some of your revenue streams may have slowed or stopped. And there's a lot of organizations out there, both for-profit and nonprofit, that are feeling that pinch. So we wanted to spend a little bit of time today discussing some ideas or ways that you can manage your cash flow during these times, which at this point we're not sure how long that will last, but at least to give you some ideas to chew on, some good ideas in how to speed up the inflow of cash, but also slow down the outflow of cash so that you can continue operations as best you can. So the first thing that you want to be doing is you need to understand your current cash position and make an assessment of what your current reality is and be communicating that. So in a nonprofit situation, you want to be communicating that with the upper levels of management. If you are upper levels of management, then you want to be coordinating with your board of directors, your treasurer, people like that that are helping make a lot of the decisions about the future of the organization and that can help with making some of those cash flow decisions, both short-term and long-term. So in taking stock of your current reality and making sure that you're communicating, you want to be doing that in real time. You want to be doing it clearly and concisely and have some actionable items when you go to the board or to upper management. So instead of just saying, here's where we stand, you want to have some ideas of, all right, here's how much cash we have, and based on our necessary expenditures and what we plan to see as our income, here's where we will be in the next week, month, 2 months. So we'll come up with some ideas on how you can do that as we move forward through some of these slides. But again, your communication needs to be, based on the most recent information available. You want to be prioritizing the cash impact items and not getting lost in the details. You want to focus on the large items that are going to have an impact in the near term on your cash. And you also want to be updating your budget. I assume in a lot of cases for most organizations, I don't want to say your budget has gone out the window, but certainly what you had planned for your budget at the beginning of this fiscal year or calendar year is probably significantly different than what you're experiencing right now. You want to move to the next slide, Robin? Oh, thank you. So in terms of understanding that cash position, you want to determine the method and frequency of that communication with management or with the board. So you want to be asking yourself what level of detail is necessary. Again, something I'll keep going back to is not getting caught in the details. You don't want to be giving your cash ledger to the board or to management on a weekly basis. You want to be giving them something like a dashboard or something that's easily digestible so that appropriate decisions can be made. You want to determine what that format should be. Again, what level of detail? Do you want to do it in the form of a dashboard, a cash flow projection, something that's relatively easy for the user to understand, but also easy for you to update? So everything is very fluid right now. You're not going to be making these cash flow projections for the next 2 months and then not have to tweak them down the road, because certainly as things come to fruition and as things actually happen, they're not necessarily going to align exactly with what you expected. So you want to put it in a format that you don't need to rework things from scratch every time something changes. And then you also need to determine who you're going to be interacting with. If you're interacting with people that are more technical from accounting perspective or financial perspective, it's going to change the content and the format of what you're presenting versus dealing with people who are just, general board members that may not have as much of an accounting background. So some inflow improvement ideas in terms of accelerating your cash. I apologize, Robin. Can you go back one? Looks like we may be missing a slide here. Something got out of order. But one thing that we need to be doing here is evaluating your current resources. You need to look at all cash assets from all sources. And in doing so, you need to be considering what you have in the bank, what line of credit availability you may have with the organization. It may be hard to set something up like that at this point in time, but if you already had a line of credit in place or some short-term borrowing availability in place, include that in what your total available resources are. And you also want to be, considering what investments you have. Now, this may not be a good time to be dipping into investments. Certainly, the market has been significantly dropped after all of this started, and it's been up and down since then, but certainly we're still down below where the market was when we started. It's not a great time to be selling off those investments if you have other means of cash that you can do so in a more efficient manner. So again, if you can borrow on a line of credit and have a relatively low interest charge, that's much preferable to dipping into investments or endowments. And you have to be careful there too, because there may be restrictions on how some of this cash can be used. So that's something that I'm not necessarily going to hit on in great detail, but you always want to be considering, all right, what cash do we have available, but also what cash can we even touch, or what assets can we even touch? Because if they're set aside by the donor for a certain purpose, you need to make sure that that cash is going towards those purposes. It might be a great time right now to be looking at dipping into some of those restricted funds. So for example, at my church, we have many, many restricted funds, and we take those into account at the beginning of each year when we're determining our operating budget. So if there's money set aside for nursery or childcare, and there's enough money in our budget to continue operations there, we may not dip into those restricted funds. But now might be a great time if you have restricted funds for a certain program to start to use those to keep that program running and let the other cash that's out there available to, run other operations or general and administrative or payroll. So those are things to be considering in terms of what cash you have and what sources you have for cash. And again, obviously, you would want to be looking towards any of those governmental programs, the PPP loans, the deferral of payroll taxes, those types of things. Now, using that cash assets and investment assets as your starting point, you want to create your cash forecast. So you're going to start from the beginning, where you're sitting at now in terms of a cash position and a liquidity position. And you want to look at anticipated cash inflows and your outflows. And it's important to know what cash flows are unavoidable. So looking at inflows, your contribution income may be uncertain at this point in time. So when you're preparing this cash inflow portion of your cash forecast, do your best and use your best judgment when coming up with what your inflows are going to be. At this point, we're a couple months into this process. You may have a better idea now of, where your normal monthly income levels are going to be. It may not be at the levels they were, a number of months ago or last year at this time, but you may have enough information now to have some kind of idea in terms of what your normal monthly income is going to be. And then you want to consider your actual inflows and not just the recorded revenue. So in some situations, an organization that relies mostly on contributions may not have much in the way of bad debts or anything like that, but you don't want to be basing things on the revenue you're recording. You want to base it on actual cash that you think you're going to be receiving in that month. So just kind of take that as food for thought. If you're doing, if you're doing a lot with county contracts or other services to outside organizations that's part of your program funding, be taking into account when those services are actually going to be paid for as opposed to when you're going to be billing, because they're not going to be one and the same. And then look for ways to speed up the inflow of cash, which we're going to talk about a little bit later. So some cash flow improvement ideas would be, you need to consider opportunities for other or new sources of income from donors. So this is an opportunity for either you or upper management or the board to be reaching out to some of your larger donors to see what they may be able to do at this point in time. It's been a very trying time financially for individuals, businesses, and for nonprofits, but there's also a lot of people out there who are bending over backwards to try to help organizations that they really care about. So it might be difficult right now to be going to foundations or individuals and asking them for additional funds, but you may be surprised at what you're able to generate by reaching out to some of those donors who have taken care of your organizations over a number of years. They may be able to accelerate when they're giving. Maybe they typically have given in June or September. Maybe they would consider doing that now in order to relieve some of that cash flow crunch that you're experiencing right now. You also want to encourage electronic payment methods to try to speed up how quickly those funds are coming in. Yes, you could include credit cards in there. You're going to pay a fee on that, but at the same time, one way to look at it is you're getting access to that money sooner. In some cases, maybe it's a gift that you otherwise maybe wouldn't have received. So paying that couple percentage points on those credit card contributions or credit card cash receipts may be worthwhile at this point in time, depending on how strapped for cash your organization is. And then also you can try to speed up the invoicing process if possible. So again, if you're an organization that is providing a service to the public or to individuals, if you're able to speed up the invoicing process and make it electronic, maybe be sending out invoices via email as opposed to doing it via standard mail, it may speed up the cash flow, the cash inflow process. In terms of forecasting for cash outflows, look for opportunities to slow down your disbursement process. So anywhere that you can be deferring, and we'll get into some other ideas, like Bob mentioned before, there are the deferral programs for employer payroll taxes to look into. You can also consider canceling your significant or your flexible automatic payments so that you have total control of when your money is going out. Because you can spend all this time creating a cash flow model and a cash flow forecast or budget for the next week, month, 2 months, but if you're not able to manually manage when that cash is going out, it really means nothing to you. So right now would be a good time to go into your banking website and to pause or cancel a lot of those automatic payments so that you can stretch some of those payment terms and actually have total control over when that cash is going out. Like I said, you want to stretch your payment terms where possible by contacting the vendors, seeing if, usually your terms are paying within 30 days, see if you can get it to 45 or 60, or if they can make some special accommodations for you. And then obviously, I'm sure everybody is doing this right now, you want to be considering the necessity of each and every expenditure. Does it need to happen now, or does it need to even happen at all? You should be asking that of yourself and of your program directors and people that are incurring those costs, and saying, can we get by without incurring that cost? Will our program be negatively affected if we incur that cost later in the year, or if we don't incur it at all? So in terms of preparing that cash forecast, we want to prepare a weekly cash forecast using the information that we previously discussed. And the forecast should help you identify any areas or times of concern. So again, this doesn't need to be anything that's extremely, extremely detailed, but if you're doing it on a weekly basis, it should just be a rolling schedule. Excel is usually going to be the best format to do this in, but start with your current cash, look at what you think your inflows are going to be for the next week, and you can show that in as much or as little detail as you think is necessary. If you're using it for a tool for yourself, you might be able to do it in a more summarized format. If you're sharing it with management or the board, you're going to want to add a little bit more detail to show, if you have various revenue streams in terms of your inflows, you might want to break that out by revenue stream so that they understand what assumptions that you're making and how much money is coming in from each of those sources. But doing color coding and things like that could be really beneficial. If you're experiencing a certain week where you expect your cash is going to be a net outflow, maybe have that highlighted red or yellow or orange. And then in weeks where you think you're going to have positive inflows, highlight those in green. If you have certain transactions or inflows or outflows that are questionable, you might want to have some kind of tick mark or color code that draws the reader's attention to that transaction or to that time frame so that it can be discussed with management or the board. But again, this forecast will help you identify the major sources of income and expense, and the areas or times of concern can then be discussed with management and the board on how to fill gaps. And we'll talk about some opportunities or some ideas of ways to fill in those gaps where things are a little bit tighter. So how to fill some of the gaps in cash availability. You want to, like I mentioned before, reach out to your significant vendors and attempt to modify your payment terms. So interact with your mortgage company or your landlord to discuss deferrals. Attempt to renegotiate your pricing with vendors. So if there are certain major vendors that you use on a regular basis and you're able to interact with them and see if you can change the level of supply that you're getting or what the unit pricing looks like or something along those lines. Again, that's easier said than done in a time like this where most organizations are probably feeling the same pinch that you are, whether they be for-profit or not-for-profit. You also want to try to defer purchases or deliveries based on your current activity levels. You may have worked with one of your vendors to, if you have some type of food delivery, or if you're providing meals to the users of your organization, you might be able to trim back on, how much volume of product that you're bringing in right now. So you may still make them whole on that purchase order, but you want to defer when those deliveries are coming in and when you're getting billed for those. Again, you might not be able to cancel costs in all cases, but you can at least stretch things out. Some other ideas in terms of ways to fill gaps in cash availability is, again, like I said, reach out to donors and see if we can accelerate when some of those gifts are coming in. If they were usually a year-end gift or late summer gift, see if they can do something about that now. And then look at your list of major anticipated cash outflows, both recurring and non-recurring, in the near future, and try to determine what is necessary and what's not. So some examples here could be your insurance coverage. You typically have paid for 100% of your insurance coverage all at once at the beginning of that policy term period. Let's say it's a May or June policy start date. See if there's an opportunity there for you to stretch that out into monthly payments, quarterly payments, something along those lines, so that you're not paying all up front for 100% of your yearly insurance coverage. That's something that a lot of organizations should probably be interacting with their insurance brokers or their providers on, if they're not already on one of those monthly or quarterly rotations. So one other topic that I wanted to touch on was budgeting. And I mentioned it a little bit earlier about the fact that I don't want to say your budget is out the window. So you certainly don't want to just scrap the budget that you had. You want to be updating your budget based on this cash flow forecast that you have put together now. And you want to start with your current budget and your current financial statements, and then identify where your inflows and your outflows have changed, so that you can modify your budget accordingly. And focus on a more simplified format, potentially. You may not go into as much detail as you typically would have when you do a budget, but you should at least be able to take what you've learned, take what you've been able to defer, and those types of things, and build that into an updated budget that you can share with your upper management or with your board of directors, and take those things into account. If you're a June year end, you're probably going to start working on your 2020/2021 budget in the near term. Again, we don't know what the next year holds, but you can start to take some of the things that you've learned in surviving these last 2 months and in doing these cash forecasts. You should take those things into account when you're doing next year's budget. But you want to be keeping track of this cash forecast and this budget probably on a weekly or monthly basis, because so much is up in the air, so much is changing. You could be basing this cash forecast that you're preparing on a weekly or monthly basis on the best information you have available right now, and that could totally change next week. So be putting things in a format so that you can be updating them in a relatively simplistic manner, so that you don't have to go back and totally start from scratch. But those are the considerations that I have from a cash flow, cash forecasting, and budgeting perspective. I don't know if Bob or if Robin have anything else that they want to add as wrap up or follow up on any of the questions that they've seen come through during their sections of the discussion.
Jason, I think what we'll do is, before I get started on the impact on the external financial reporting, again, we will go through the questions because we only have about 10 minutes and we want to be respectful of everybody's time. We'll go back and respond to those via email or phone call, in one way, shape, or form, to make sure we address your concerns. The last thing we are going to talk about is going to be the impact of this on external financial reporting and audits. And again, for some of you, your audit is going to happen sooner rather than later. For those of you whose year end is in September or December or somewhere in between, this may not be as applicable, but nonetheless, the things that we're going to talk about will probably still impact you in December, maybe just not as significantly. So the first thing we do want to talk about is, prior to your auditor coming in, one of the things that they're going to ask you and talk to you about is essentially an evaluation of the impact on your operations and financial position of this situation. So for example, it would, and I realize most of you have probably already done this and are aware of this, but if you have not, you're going to need to quantify, what were the impact on revenues. For some organizations, they may have gone up for some reason. For many, they will have gone down. Maybe a program, you may have had to cancel a program. So for example, some of our private schools who would run summer camps, they know that, that the summer camp is not going to happen. Now, in that instance, that's probably more in the next fiscal year. But you need to look at your programs, need to look where you were at in terms of your revenue and what impact did that have on your financial position. The flip side of that is you're going to look at your expenses, because while your income could have gone down or may have gone up, there's probably a correlation in terms of your expenses, especially if in addition to payroll you are providing, you purchase goods that need to be, widgets, so to speak, something that goes out the door. So you want both an assessment of your income and your expenses, where you stand currently. Again, we're going to assume a 6/30 year end, but you also need to look at this prospectively. How long do you think these changes are going to impact your organization? Do you believe that by losing this program or having to delay it, will it be likely that it can potentially start back up in September or October? Or is it something that, as you've watched what has happened, you thought, well, maybe it's time for this program to be less of a focus because we've done something else in the meantime, which is providing us revenue streams that we were not anticipating. So you need to do both a current and a prospective evaluation of this. And then you're going to have to do essentially management responses, i.e., sort of explain, and I know realize it's easy to say, well, it's all COVID, but depending on the significance of this assessment, explain the impact, explain going forward, explain why you believe you can come through this, or why you think this could significantly impact your organization. Back in the day, we used to call this a going concern evaluation, and I hate to use that term because it makes it sound as if there's a potential that your organization cannot survive. That is not the purpose of this, but it is to make sure you understand and can transmit that information to your professional service providers, in this particular case, your auditors, so that where you're at makes sense to the people that are reviewing the information. And when you get to your financial statement disclosures, are you going to, in some capacity, need to explain this in the financial statements? In terms of COVID-19 and disclosures, there will, of course, be a sub-event disclosure. For anybody who's having a 6/30 year end, again, at minimum, the disclosure will essentially tell the reader that you're in the middle of a global pandemic, the impact of which, for those of you who sort of are like, that's not really impacting us all that much, that's a great thing on a lot of fronts, right? But the disclosure would at least say, we're not sure if this could potentially impact operations or our financial position. If for some reason, once you do this assessment, you recognize there's been a significant change, and a reader of your financials is going to look at this and say, wow, what happened here? The last 3 months of revenue have gone away. Then again, that's where that management response comes in, and then an evaluation as to how much you need to disclose or want to disclose to the reader so they understand the shift in your position. Last year, with many of you adopting the new guidance for nonprofits, one of the requirements was the liquidity disclosure in your financials. This, of course, will continue to be a disclosure, but the impact may be a little more interesting this year in terms of what you have to disclose to the reader, because, of course, this disclosure is telling the reader how much, what your resources are for meeting operations. And so while you may still look as if you've got a good cash position, If you've got money, you've got cash sitting in an account, but it is for restricted purposes, then of course that comes out of the liquidity available for operations. So that is a disclosure that will have to have a little more thought put into it if you're in a position where it appears as if you may have some shortfalls in resources. But the flip side of that is, again, if you're getting funding from foundations or you anticipate getting a loan, that of course needs to be taken into consideration as money you will have available. For those of you who have taken out the PPP money and or other loans, those of course have to be disclosed, and anything related to the anticipated payment requirements. At 6/30, since you probably will not have a determination as to whether or not the loan has been forgiven, it tends to be a pretty standard disclosure that basically, what you took the money out for, you will apply for forgiveness, and you will assess the repayment of that after you receive the information from the bank. And then the change in grant provisions. I know many organizations have been working with their funders or their donors, people who have given them money, and they have, in many instances, asked the donors, or the donors have said, hey, money we wanted for restricted purposes, go ahead, just spend it. Keep your people on payroll, use it to pay the bills, whatever. So if there have been any changes to money that had been previously restricted, of course that will flow through as now unrestricted or money that's no longer has restrictions applied to it, and then there'll be potentially some disclosures related to that. The other thing we do want to discuss quickly is remote auditing. Again, this is more of an issue because of the 6/30 deadline. Just a fast summary. Number one, remote auditing is an accepted option under generally accepted auditing standards. So while it seems as if it's been coming to the forefront, it's always been an option. And so therefore, please understand your auditors can do a remote audit if that is what you want. Communication will be key, both in terms of the transmission of information. Again, with people sometimes not being in the office all the time, it's going to require a lot of coordination to be sure that the auditors get their request to you timely and the information goes back and forth in a manner that's efficient. There will still be probably some face-to-face interactions with Zoom, simply because certain questions, it just seems as if you feel more comfortable having a conversation when you can look at somebody. Again, we talked about timing and receipts, request and receipt of information. The format of audit evidence, again, we can take PDF copies. That's something your auditor can work with you. Possibly you do a screen share and they're able to access your accounting software to see how transactions flow into your general ledger. So these are all topics to be addressed in your planning meeting with your auditors, simply to make sure you do this effectively. Security of client data, again, email tends to be a little limited in terms of its security, so therefore the establishment of portals or other secure means to transmit information. Fraud inquiries will continue to be a part of an audit. Again, you go back to the Zoom conversations. That is something that will probably be done more when you're looking at somebody via a Zoom as opposed to just a phone call. And again, meetings with management and the audit committee, something that probably will be done via Zoom, but should still be, it obviously has to be part of the audit, but again, the way it gets done may be changed a little bit. And the last thing I do want to talk about, and I don't want to, because we're basically at the end here, is internal control. With the sudden shift in workplaces and styles and the resources, one of the things that management does need to do is evaluate the impact on your internal processes due to these shifts, especially remote work. Well, you may have had a series of internal controls in place, and we recognize with a lot of nonprofits, there's a limit to how many controls could be in place anyway, because you have a limited number of people. Once everybody was working from home or in other locations, that may have impacted the ability to keep those, to follow the normal protocol in terms of your processes. So you need to evaluate, how did those processes change? How did the changes in those processes impact internal controls? And you do want to document that for your auditors prior to their arrival. And even if you have a 12/31 year end, and presumably we will be out of this phase at that point, still during the process, the remote work process, that information still needs to be provided to the auditors so they understand how that changed what you did. And again, you need to make sure there's communication among your team regarding the changes in processes and continue to evaluate opportunities to mitigate risk. And as I said, you need to document the change. We're not going to go over the technology considerations, I think, in the interest of time. So it is 3:30. We've basically reached the end of time. What we can do is we're willing to stay on the line if anybody would like to ask some questions. And I'm going to go through some of the Q&A. The items on the Pension Protection Act, I think what we're going to do there, or the PPP funds, is we're going to sort of have Bob assess those individually. I don't know if there's anything else that needs to be brought forward. Most of these are on PPP. Carissa, do you want to explain to people how they can ask questions now in this last Q&A period? Because I will be honest, I don't know how to let people take that step. If you need to unmic the webinar, what you need to do.
Can you guys hear me?
I can hear you.
Okay. So I think the easiest way, Robin, would be if anyone who has questions were to send them in the chat portion, as opposed to specifically to the host, which is me. I think that way, if I believe I'm correct, the panelists all can see them as they pop up. And for those that we may not be able to get to, I will be able to kind of gather these all at the end, and we can email you or call you specifically if there's a question, like I said, that we may not be able to get to in the interest of time. So like I said, if you can forward them kind of to the chat, I believe everyone panelist-wise will be able to see them and answer them accordingly.
Thank you, Carissa. Pam, I see your question, and I think that is a question I'm going to direct to Bob Grossman, because again, that's more related to specifics of the PPP loan, and I don't feel I'm qualified to answer that, but we will get you an answer to that.
That answer's already on the way.
Oh, thanks, Bob.
You're welcome.
All right, well, in scrolling through, it doesn't look like we're receiving many questions. So we are going to sign off at this time. We really appreciate you taking the time to participate in this webinar. Again, for those of you who have more questions or an interest to hear more about the PPP program and the other programs related to the CARES Act, I mean, that's just such a complicated, maybe complicated isn't the word, but there's just so much information related to that. We really do encourage you to sign up for the webinar that Bob and his team are doing on Friday. We also encourage you to email us. Our email addresses are at the back of the slides with any other questions you have or comments. And frankly, if there are other topics you would like us to address, for those of you who have been part of our program downtown, you know we do like to do programs live, but in this situation, if it makes more sense to do it electronically, we are certainly willing to do that, and we want to cover your needs as well. And again, any feedback you have, we appreciate it. I believe Carissa will send the slides out after this presentation, and so if you're looking to have those, they will be made available. Thank you.